very well-known macro investor Maneesh Dangi, who's joining us live on today's edition of The Market. Good morning. This is Nayantara. The last time we had you on the show, the bond markets were still not reacting to inflation. That was something that you had also talked about. Finally, we have seen the action on the bond market. If you could quickly put it together for us, how you're reading this. I still remember a month ago, you also said you were going underweight on equities.
Good morning, Nayantara. So, the setup for Indian equity remains a no-win one, and not just the bond market and financial condition related, but also the oil prices. So, on either side of the aisle, I think weakish setup exists for us. But to take a step back here, just talk of what happened last night. So the Fed's move basically suggests that it actually wants to use a tightening of financial conditions to impress upon economy and inflation both. It actually actively wants to perhaps even slow economy through tighter financial conditions. Because remember, the press, before the press statement was put out, market actually was rejoicing the Fed's move because it was on expected lines. March hike, taper, and then eventually some form of tightening. But then, when press asked Fed Powell whether the tail risk that people are worried of, which is 50 basis point hike and more frequent rate hikes, more than 4, were they off the table? And in some sense, Powell said that they were not off the table. So that actually spooked the market. So, the setup we have, Nayantara, now is that it is very likely that the violent move of bond market would continue. Even in the setup when otherwise economic data is beginning to slow, the new mandate and the new pivot of the Fed is to tame inflation in some sense, even if it takes substantial slowing of economy. And that setup actually is good for dollar, bad for bonds, bad for equities, and of course bad for emerging market currencies. And so that's the narrative that I anticipated over last couple of months, and is starting to play out.
Okay, so the question then also is, Maneesh, what will happen with India? We had seen a straight line rally which started to come under threat in November. That's when you were talking about how you were looking at farmland. In December, you were talking about going underweight on equities. I think a lot of our viewers today will want to know what's going to happen to the construct of the Indian market. Can in 2022 continue to outperform when there is also a lot of chatter about PE compression?
So yes, Nayantara. So Indian markets or any equity market, as we all know, while we like to sort of think of it as some isolated place, which actually is driven by purely Indian earnings and Indian rates. Now, the truth is, as we've discussed many times, that it is simply a part of the big sort of global machine, and it's very, very difficult to imagine a setup in which US markets are correcting or other global markets are correcting, and India is actually still sort of rallying and putting on more weight. So I think, my base case continues that until the market sort this out, in terms of the divergence that it has in terms of its view versus a view that Fed is putting forward now, until market is ready for a world, Nayantara, and it's an important thing to remember for many investors who have gotten habituated to something like QE, that it's likely that for many years, instead of QE, we'll just see a reverse of it. Instead of a setup in which every time asset market sold off, the Fed came to sort of put a put to it, in a sense that, they turned sort of more benign I think we will have a setup in which the Fed would not bother about stock markets for at least for now. And to that extent, we're not living in a very good setting. I think that a template applies even for India. If I see dollar appreciate, which I think it will, if I see US treasuries actually sell off, which I think that will continue, at least the shorter end, we saw 2-year treasury actually move up from 102, 103 to 118, which basically meant that, now markets are actually pretty much pricing 4.5 rate hikes or even more in next 12 months. In that setup, Indian central bank will have to act. It'll have to lean in terms of tightening, though our growth, its narrative is not as strong as that of US, and our inflation is not as bad as US. Because we are emerging market, we don't have too many choices. So I'm afraid that purely the macro setup, Nayantara, is not yet good. And I think we will continue to live with a lot of volatility without any remarkable gains in asset markets.
All right, Maneesh, will let you go on that note. In fact, just a couple of minutes ago, you had Uday Kotak tweeting that with the Fed indicating this interest rate hike and oil at $90 a barrel, it's the right time for India to review its fiscal and monetary policy, and that the budget as well as the upcoming RBI meet is going to be very crucial.